Yesterday, silver lost nearly 10% of its value in a single trading session. Wall Street panicked. Traders dumped their positions. Prices crashed from highs we hadn't seen in decades. But here's the part nobody is talking about. While the West was selling in a frenzy, China was quietly buying every single ounce they could get their hands on. And right now, as we're recording this, there is a $10 gap between the price of silver in New York and the price of silver in Shanghai. That gap, it's making certain people very, very rich. Stay with me, because by the end of this video, you'll understand exactly what's happening in the silver market, why it matters to you, and what the smart money is doing right now. Let's get into it. Before we dive in, nothing in this video is personal financial advice. I'm here to break down what's happening, what analysts are saying, and what tools you have available. Always do your own research and speak with a qualified advisor before making any investment decisions. What actually happened yesterday? Okay, so to understand what's going on today, we need to rewind just a little bit. At the start of 2026, silver hit an all-time high of $121 per ounce. That's not a typo, $121. Now, as of right now, March 20th, 2026, silver is trading around $70 to $72 per ounce on the Comex Exchange in New York. That's the main Western market where silver futures are traded. And yesterday, March 19th, it dropped somewhere between 4% and 10% in a single day, depending on when exactly you were watching the screen. Now for context, a 5% move in the stock market is a crisis. A 10% move in one day for any asset is what traders call a bloodbath. So what caused it? Three main things. Number one, the Federal Reserve. The Fed is the central bank of the United States. When they hint that interest rates are going to stay high for longer, it's bad for precious metals like silver and gold. Why? Because high rates make the US dollar stronger, and silver is priced in dollars. Stronger dollar equals cheaper silver price in dollar terms. Number two, pro-taking. Silver had just come off one of the most explosive runs in history. When something goes up that fast, smart traders sell to lock in their profits. That selling pressure compounds and creates a domino effect. Number three, geopolitics. Iran-related tensions and global risk-off sentiment pushed investors toward cash, not commodities. So yes, it was a brutal day, but here's where it gets interesting. Because while New York was in full panic mode, Shanghai barely flinched. And I want to show you exactly why, right after I break down one thing most people completely misunderstand about silver. What even is silver, and why does it matter? Quick pause here, because if you're new to precious metals, I want to make sure you're not lost. Most people think silver is just jewelry or old coins your grandma has. But here's the truth. Silver is one of the most industrially important metals on the planet. About 60% of all silver demand comes from industry, not investors, not jewelry buyers, industry. Every single solar panel uses silver. Every electric vehicle uses silver. Every smartphone you've ever held has silver in it. Data centers powering AI? Silver. 5G towers? Silver. This is why silver is sometimes called the metal of the future. Because the more the world electrifies and goes green, the more silver the world needs. And here's the supply problem. 72% of silver mined globally is actually a byproduct. It comes from mines that are primarily digging for copper, zinc, or gold. Silver just comes out as a bonus. That means you can't just build more silver mines overnight when prices go up. It takes 10 to 15 years to bring a new primary silver mine online. Meanwhile, demand keeps growing. Result? The world has consumed more silver than it has produced for 6 straight years, a deficit that has now drained nearly 800 million ounces from global stockpiles. 800 million ounces gone. That's almost a full year of global mine output vanished. Now, does that sound like a market that should be crashing? I know, it sounds contradictory. And that's exactly the tension at the heart of this story. Stick with me, because the East versus West dynamic I'm about to show you is genuinely one of the most fascinating things happening in global finance right now. The big story, East versus West. Why Shanghai silver costs $10 more than New York silver. All right, here's the part of this video I'm most excited about. Right now, as I'm recording this, silver in New York is trading at around $70.48 per ounce. Silver in Shanghai is trading at approximately $80.25 per ounce. That's a $9.77 difference, a 13.9% premium for the exact same metal. Why? Let me break it down in plain English. In New York, silver trades on an exchange called Comex, short for Commodity Exchange. Most of what's traded here is what we call paper silver. That means contracts, promises. Most traders never actually take physical delivery of the metal. They're just speculating on the price. In Shanghai, silver trades on the SHFE, the Shanghai Futures Exchange, and more importantly, on the SGE, the Shanghai Gold Exchange. These markets are much more oriented toward physical metal, real bars, real delivery, real buyers who actually want the silver. Now, when Western traders panic and dump their paper contracts, Comex prices crash fast. There's no floor of physical demand to stop the bleeding. But in Shanghai, Chinese industrial buyers, Chinese investors, Chinese refiners, they see the same crash happening and they think, great, discount, buy more. And the data backs this up. In just January and February of 2026 alone, a staggering 436 tons of physical silver was withdrawn from the SGE exchange in China. Inventories on the SHFE have collapsed by 64% since late 2025. People aren't just trading silver in China, they're taking it home. This physical demand from the East is creating what traders call a floor under prices, a level where real buyers will always step in. It's the classic paper West versus physical East divergence, and it's been the defining story of the silver market all year. Now here's the really wild part. This price gap is so big that professional traders are literally flying silver from New York to Shanghai to profit from it. And I'm going to show you exactly how that works and why you probably can't do it. Right after this, the arbitrage trade, how professionals are profiting from this gap. Okay, so if silver is $70 in New York and $80 in Shanghai, the obvious question is, why doesn't everyone just buy cheap silver in the West and sell it expensively in the East? The answer is, some people are doing exactly that. It's called arbitrage, and the math on it right now is pretty eye-opening. Let's walk through the real costs step by step. You buy silver on Comex, $70.48 per ounce. You need to ship it from New York to Shanghai. Freight, insurance, logistics, roughly $1.50 to $2 per ounce. Now here's the big one. China charges a 13% VAT. That's a value-added tax on silver imports. That adds about $9.40 per ounce to your cost. Total all-in cost to land 1 ounce of silver in a Chinese vault, about $81 to $82. Now, the SHFE price is $80.25. So on paper, that looks like a loss, right? Here's the nuance. When you import silver and pay that VAT, Chinese industrial buyers, like solar panel manufacturers or electronics companies, can reclaim that VAT on their taxes. So they're effectively willing to pay you the full VAT-inclusive price, which pushes the real selling price closer to $90 per ounce, which means professional arbitrageurs who have the right import licenses and logistics networks are clearing somewhere between $6.50 and $8 profit per ounce after all costs. At 5,000 ounces per Comex contract, that's potentially $30,000 to $40,000 profit per contract. And remember, this window has been open for weeks. Now, can you or I do this? Honestly, probably not. You need Chinese import licenses, bonded warehouse access, significant capital, and established shipping relationships. This is institutional territory, major trading houses, refiners, and large commodity firms. But here's why it matters to you as an investor or observer. All of this metal flowing east means the physical market is getting tighter and tighter. And tighter physical supply over time tends to push prices up. The arb trade is basically the market's mechanism for rebalancing. And as long as it keeps flowing, it confirms that Eastern demand for real silver is absolutely real and enormous. But will this arbitrage window stay open? And more importantly, what does the big picture supply situation look like for the rest of 2026? Because the numbers here might genuinely surprise you. Supply and demand, the big picture. Why this isn't just a trade, it's a structural story. Let's zoom way out and look at the fundamental supply and demand picture, because this is where the long-term story lives. On the supply side, global silver mine production in 2026 is forecast at around 820 million ounces. That's barely 1% more than 2024. Essentially flat. Why? Remember what I said earlier. 72% of silver comes as a byproduct of other mining. You can't just flip a switch and produce more. The biggest primary silver producers, Mexico, China, Peru, are all largely running at capacity. In fact, one of the world's biggest silver companies, Fresnillo, just cut their 2026 guidance by 9 million ounces due to lower ore grades. That's the mining industry's way of saying the easy silver has already been dug up. On the demand side, total silver demand in 2026 is projected at around 1.05 to 1.1 billion ounces. That's billion with a B. The biggest single driver, industry, at roughly 650 million ounces. Solar panels, EVs, AI data centers, 5G. These aren't trends that are going away. The most exciting segment, physical investment. Coins, bars, ETFs is forecast up 20% in 2026 to 227 million ounces. People around the world are buying physical silver at a pace we haven't seen in years. Do the math. 820 million ounces produced, over 1 billion ounces demanded. That is a deficit of 67 million ounces, the sixth consecutive annual deficit. Since 2021, the silver market has consumed nearly 800 million ounces, more than it produced. The world's stockpiles have been draining for half a decade. This isn't a short-term trade. This is a structural, multi-year supply crunch. And that's the fundamental engine behind the Shanghai premium, the tight inventories, and why every single dip in price gets aggressively bought in Asia. So given all of this, the crash, the premium, the structural deficit, what actually happens next? Where does silver go from here? I've got 3 scenarios for you: bearish, base case, and bull case, and I think you'll find the range pretty striking. What happens next? 3 scenarios for silver in 2026. All right, let's talk about where this goes. I want to be very clear, I'm not a financial advisor, and nobody can predict markets with certainty. But I can walk you through the scenarios that analysts are mapping out based on current data. Scenario 1, the bear case, further downside to 60 to 65. If the Federal Reserve stays hawkish, keeps interest rates high, signals no cuts, the US dollar could stay strong or strengthen further. That puts continued downward pressure on silver priced in dollars. Add in any global economic slowdown that weakens industrial demand, solar installations slowing, EV sales disappointing, and you could see silver cut lower supports. Analysts watching the technicals, that's chart patterns, are eyeing the $65 and even $60 levels as potential next supports if the current breakdown continues. Scenario 2, the base case, consolidation around 68 to 78. This is the sideways chop scenario. The Comex paper market stays volatile, but the Shanghai physical floor holds. The east-west divergence remains. Arbitrage flows keep physical supply tight, and silver essentially churns in a range while the market figures out the macro picture. Most analysts see this as the highest probability short-term outcome. Scenario 3. The bull case back toward 90 to 100 plus. If the Fed pivots, starts cutting rates, that's historically rocket fuel for precious metals. Add in any escalation in geopolitical tensions, a weakening dollar, or a demand surge from new industrial applications, and silver's structural deficit becomes the story everyone focuses on again. Remember, silver was at $121 just 3 months ago. A return to those levels isn't some wild fantasy in this environment. The key question is, which scenario plays out first? And the honest answer is, watch the Fed. Before I wrap up, there are 2 things I haven't covered yet that I think are genuinely important for anyone watching this, especially if you're in Asia or emerging markets. Stay right there. What this means for you. A few important things to understand if you're watching from outside the US, particularly if you're in Pakistan, India, the Gulf, or anywhere in Asia. First, the currency angle. Silver is priced in US dollars globally. If your local currency, whether that's Pakistani rupees, Indian rupees, or anything else, is weakening against the dollar, you actually may not be seeing as dramatic a price drop in local terms as Western investors are. Always check your local silver price, not just the international dollar price. Second, the physical versus paper distinction. Everything we've been discussing with Comex crashing, that's largely the paper market. If you buy physical silver coins or bars locally, the price you pay will typically reflect more of the physical market reality, which tends to be stickier and less volatile than futures. Third, and this is important, dips in precious metals have historically been buying opportunities for long-term holders. I'm not telling you to buy anything, but I am telling you that the structural deficit story, 6 straight years of consuming more than we produce, doesn't change because of a one-day sell-off. The fundamentals are long-term. The panic is short-term. What you do with that information is entirely up to you. And please, always do your own research and speak to a qualified financial advisor before making any investment decisions. Okay, let's bring it all together. Here's what we covered today. Silver had a brutal correction, down up to 10%, driven by Fed fears, profit-taking, and global risk-off sentiment. But while the West sold, China bought. And right now, there's a $10 premium for physical silver in Shanghai over New York. That gap tells you something important about where real demand actually is. The arbitrage trade is real, profitable for professionals, and is sending metal east, tightening the physical market further. 6 straight years of structural deficits and nearly 800 million ounces drained from global supply means the fundamentals of this market are genuinely different from most assets. And the next move, up, down, or sideways, ultimately comes down to one thing: what the Federal Reserve does next. If you found this breakdown useful, and I genuinely hope you did, smashing that like button helps this video reach more people who are trying to make sense of what's happening in markets right now. Subscribe if you want to be here the next time something this important moves. And drop a comment below. I want to know, are you bullish or bearish on silver for the rest of 2026? Tell me your honest take. I'll see you in the next one.